Hey guys, what is going on? Welcome back to my Robinhood portfolio. Today I'd like to talk about what I would do with $1,000 if I was a new investor on Robinhood. I put out similar videos in the past, but I thought I would talk about a new investor with $1,000. What would I do? As you guys know, my portfolio right now is primarily composed of high dividend, large cap companies, blue chip companies that have great potential for long-term growth, long-term capital appreciation, but also have a very good dividend in the short and midterm as well. As you guys know as well, I have quite a few stocks that are really representing all major market sectors. So I have a lot of diversification within the portfolio. And as I scroll down here, you can see very, very large cap companies, very stable and profitable companies. Portola is one of my speculative stocks, but you can see GE, for example, very large company, Lockheed Martin, LMT, Boeing, Johnson & Johnson, Cardinal Health, Abbott Laboratories, Pfizer, Eli Lilly and Company, ABBV, AbbVie Incorporated. These are all very large companies, stalwarts of their particular market industries, name brand companies, blue chip companies that are very, very good for long-term growth and also have very good dividend yields in the short term. But as new investors are jumping onto Robinhood, it's very difficult to select these stocks, especially if you don't have a lot of experience buying and selling stocks, reviewing stocks, or really don't have an idea what to invest in at all. A great way of starting out and kind of getting around all the complexity of buying individual stocks and trying to put together a portfolio, selecting good companies, trying to pick out those ones that you think will be good over the long term versus short term, risk tolerance as well. It gets very, very complicated. Then you have to go and buy and sell the stocks, and there's always ebbs and flow in the market. So it's very, very confusing when you first start out. After you've been on the markets for a while, you've been on Robinhood, for example, buying and selling individual securities, it gets much easier to kind of pick out good companies right off the bat without really having to do a lot of reading about these companies, especially any of the S&P 500 blue chip companies. It becomes very obvious which are good long-term holds and which companies are not good long-term holds. For example, penny stocks. A lot of folks think penny stocks are easy to do. You simply have to research a few of the particular metrics they follow, algorithms, and it's much more difficult than that than actually doing in real time. Real-world scenarios does not really play out like they do in some of the educational materials that are offered. So to get around to all that complexity, a great way of investing is jumping into ETFs or exchange traded funds. And really what these are low-cost mutual funds. I have one here, VOO. I have quite a large holding of this in my E-Trade account. I think this is a great ETF because it has an underlying collection of a lot of the individual S&P 500 blue chip companies that would make any investor a very good portfolio. But you don't have to worry about the complexity of buying individual stocks. You simply buy this one stock and it tracks an index of all of the other companies on the S&P 500. And you can see that nicely illustrated and described on the bottom here. The Vanguard S P 500 ETF tracks a market cap weighted index of U.S. large and mid cap stocks selected by the S&P committee. And the market cap weighted index simply means that it every once in a while rebalances the portfolio based on that index alone. So there's not a lot of active management happening. Basically taking if a stock particularly is doing particularly good, the market cap will increase and the fund will have a greater proportion of that as the underlying stock in the portfolio. The other great part about the ETF here is that, so I should just mention, ETFs like mutual funds have some fees associated with those mutual funds. You'll never, or excuse me, ETFs, you'll never see the fee. It's automatically taken out of the stock price. So at a later date, you won't get a bill necessarily for the expense, but it is taken out of the stock price. So indirectly, it decreases the stock by a very small fraction, but over the long term, it can really have a big impact on your overall return of investment. A lot of mutual funds, for example, have expense ratios 1%, 2.5%, which over a year or so with a smaller portfolio, you don't really notice that. But if you start building up into the hundreds of thousands of dollars worth of holdings in over 30 years, that's literally thousands of dollars. So the good way of doing this is trying to select an ETF, again, a collection of stocks in one stock that has a very low expense ratio. And this is a perfect stock to do that with. It's got S&P 500 companies, blue chip companies that have long-term growth potential, have dividend payments as well. You can see on the bottom here, this does have a dividend yield, 1.94%, which is pretty good in and of itself. And the expense ratio is only 0.04. So again, in comparison, a lot of mutual funds have 1%. So really, 100 versus 4 for this particular ETF. 0.04 versus 1.00, or even higher than that. Some mutual funds are 2.4, 2.5%. So you can see over the long term, they can really eat into your net profits. But ETFs like this are very good because there's not a lot of active management. They simply follow an underlying index, again, described on the bottom here. And you can see it's a very large fund, $69.93 billion. So a lot of investors will simply park their money in these particular investments and really can forget about it for 20 years, 30 years before you cash out. In the meantime, you're getting those dividends. And this stock really should have really good capital appreciation. It should closely track the underlying S&P 500. Basically, if the S&P goes up, this stock will go up. And you can see here, this is mirroring almost identical to the S&P 500. Over the last year, up 18.78%. Over the last 5 years, up 101.75%. So again, about equal to the underlying S&P 500 index. The companies, like I mentioned, are all large cap blue chip companies. The number one holding in this particular ETF is Apple, number 2 Google, 3 Microsoft, 4 Amazon, 5 Facebook, 6 ExxonMobil, 7 Johnson & Johnson, 8 Berkshire Hathaway, and that's a Class A stock, 8 JP Morgan Chase & Company, and 10 General Electric. So these are all very established companies, very profitable companies. So this is a perfect stock to invest in for long-term capital gains as well as a nice dividend as well. Here is another one, a Vanguard Dividend Appreciation Fund as well. And you can see on the bottom here, it's simply tracking index as well. This is tracking a market cap weighted index of U.S. companies that have increased their annual dividends for 10 or more consecutive years. And really, it's about the same companies as the prior, with notable absences of Google, for example, Amazon, for example. They don't pay out dividends. Berkshire Hathaway as well. But a lot of good large cap blue chip companies in this particular dividend ETF as well. To get a little bit more risky, you can also invest in smaller companies that have potentially a little bit better performance with regards to capital appreciation. So over the long term, a lot of the large blue chip companies are really as big as they're going to get, and they're going to have good performance. But some of the larger some of the smaller companies, mid-cap companies, small-cap companies have a lot of room to increase. For example, Amazon 10 years ago would be a small or mid-cap stock, and you can see really if you bought in when it was that small, now you'd have a very, very good rate of return. But the unfortunate part of some of this is that they're a little bit more risky. So they're still very good companies, but they're much more risky companies because they're not dividend aristocrats. They're not the stalwarts of their particular market industries. They're companies that are up and coming and growing, but still not made it to the point of being essentially a perennial company that's always going to be winning in their market sector. So because of that, they're a little bit riskier, but they have a little bit higher rate of return, and that's really the theme in the stock market. The higher risk tolerance you have, the better payout you can potentially receive. But again, it's a lot more risky. You can also lose your money a lot more quickly or severely as well with some of these stocks. This particular expense ratio, very good, as all Vanguard stocks I'll be talking about are 0.06. And the companies that this particular ETF invests in are companies like Western Digital, Lam Research Corp, Edwards Life Sciences, Roger Technology, CR Bard, Equinix. A lot of these companies are smaller companies, but up-and-coming companies that could have great long-term potential if they break through. But there's also the risk that they could collapse. So that's why it's a little bit higher risk, but a little bit higher reward as well. And you can see it's a very large ETF, $19.61 billion. So this is not a small company by any means. And you can see over the last 1 year, very good performance, 17.68%. Over the last 5 years as well, 105.22%. So almost tracking like the large cap Vanguard stock was, the underlying S&P 500 index. Here's another one, VOT here. Again, 1 year, 17.24, and 5 years, 94.3. So a lot of these are going to be similar because they're tracking similar indexes. This one is tracking a market cap weighted index of mid-cap growth companies selected by the Center for Research and Security Prices. So a little bit different index, but really containing most of the ETFs that that prior one did. And then to get very risky, you can invest in small cap companies. So these are very small cap cap companies, less than $5 billion for market cap, which is still big, but these are a lot more risky with regards to the underlying company portfolio. Again, very good expense ratio, 0.06 for this particular stock. Again, it's very large, 18.70 billion. Good dividend yield, 1.481, or a reasonable dividend yield anyway. And the companies that are contained in this particular ETF, CDW Corp, Packaging Corp of America, Teleflex, Cadence Design Systems, Diamondback Energy, Domino's Pizza, UGI Corp, Atmos Energy, Steel Dynamics. A lot of companies that are probably not that well known, but have a lot of potential for growth in the future. But again, this is even more risky than the mid-cap stocks, or at least just as risky. I would say a little bit more risky as well, because these are not established companies like the large cap stocks, and even some of the larger mid-cap stocks. These are very new companies that, again, could have very, very good long-term growth potential, but have a lot more risk associated with them. So what I would do if I had $1,000 going back to the large cap stocks, I'd put probably 50 to 75% of my money into this particular stock. You simply buy, $750 worth of this stock. You can buy 3 shares of this particular stock. And then the rest I would put into these companies. Maybe buy a share of the mid cap and then maybe a share of the small cap to round out your portfolio. And then as you get a little bit more capital in the portfolio, and really depending on your risk tolerance, you could put a little bit more into the mid cap stocks or a little bit more into the small cap stocks. And then once you start doing a little bit more reading about the markets, learn a little bit more how the stock market works, buying and selling individual securities, then you can start going in and buying individual companies from the underlying ETFs. For example, a lot of investors have been buying Apple, Google, Amazon. Tesla is also a very new company, a very good company that could have a lot of long-term growth as well. Facebook comes to mind. So you can really start diving in and augmenting these with some of your individual selections. And that's really what I've been doing with my Robinhood portfolio. This portfolio is a portfolio to learn with, but I still have my Vanguard and E-Trade accounts that have a lot of these types of stocks. I personally have VOO. I have quite a large proportion of VOO. I have VIG. I do not have VO, but I do have VOT, and I do have VB. That's the reason I selected these stocks for Robinhood. And then I also have a number of other ETFs as well that I don't have listed here, but there's ETFs, for example, the aerospace industry. There's ETFs for almost any type of industry or market sector out there. So once you get on to some of these larger funds that are really just tracking the underlying S&P 500, then you can start diving into more specific types of ETFs. So just wanted to quickly talk about what I would do with $1,000 on Robinhood here. If you guys have any comments or suggestions, additional or better ETFs, let me know as well. Kind of with that, I'll end the video here. As always, if you guys enjoy my videos, feel free to like, share, and subscribe. In this next video, we'll see you then.